Hello everyone, my name is Kamal Manocha. I present PMS AIF World. Like every Friday, we have a very interesting webinar that we have planned today with another founder of a PMS which has a 10-year plus pedigree and has been actually doing consistently well. They have multiple PMS offerings, but we are not going to discuss particularly any product. This is a thought leader conversation that we have planned today, before Diwali, to understand from Ravi Dharamshi, who is our guest speaker today and who is MD at ValueQuest Investment Advisors, to understand his thought process and what his wisdom says on equity markets in the current context. We know equity markets over the last 2 years have actually been doing in a range bound manner. They have small and mid cap space has done well, but quality side of markets have actually been struggling. Maybe before 2021, we had learned this lesson from some of the prominent fund managers that one should actually be avoiding the deep value kind of stocks and businesses, but one should focus on quality because in long term, quality delivers and quality comes with growth. Deep value comes with a lot of uncertainty. However, those learnings have been challenged in last 2 years, where we have seen value style of market actually doing well because maybe interest rates have gone up. After inflation went up, after we saw there was a Keynesian economics followed, during COVID times, and which led to inflation, which led to increase in interest rates. So, last 2-3 years have been very interesting. We have been watching everything, and absolutely we have been covering every perspective of every portfolio manager, and we know, what are the right decisions to be taken at any point of time, and that is where we have been helping our clients make very well informed investment decisions. We are actually equally keen to hear you, Ravi, today on this webinar, where the topic is also very, very pertinent, that ahead of us we have in this decade a lot to happen for India's economy. We from 3.5 close to 4 trillion today want to grow to 6 trillion. Everybody is looking at India's economy, and everybody is hopeful. In fact, for our next annual event that we have planned, that the title of that event is that we'll see 6 trillion economy in 6 years. Obviously, hence there are a lot of trends, a lot of high growth sectors which could shape up, and we could see that by 2030, the stocks which represent Nifty 50 today in terms of top stocks, maybe those are also change. So we'll cover all that, in terms of what is your expectation in medium to long term in terms of high growth sectors and fast growing companies. So warm welcome to you, and very warm welcome to all of you who have joined us today. Over to you, Ravi, to kind of give your opening remarks on what is your perspective on markets in terms of, say, valuations and what is happening in front of us in the current context. Do you see markets optimistically, or you see there are risks? What is your frame of mind at the current context? I do not want to bias your mind by posting any question, but I want you to just speak out, in a very unbiased way, putting yourself in investor's shoe. How do you see market at the current point of time?
Sure. Thanks, Kamal. Thanks a lot for the opportunity, and thank you all for joining in. I'll give my sense of how I look at the market, what is the framework that I use to see where are we, what stage of the market cycle are we in, what stage of the economic cycle are we in, and hence how we should put everything in that particular context. That's my way of looking at it. So I'll just give a sense of I'll rewind back the clock to 2007. In fact, only one real boom that India has witnessed was from 2003 to 2008. I mean, I'm not counting the boom prior to 92. That was, there was still a lot of gap in Indian economic. It was more a flows driven and valuation driven rally. But the really fundamental economic change that has happened post opening up of the economy was only a 5-year period from 2002-3 to 2007-8. So that was the period which I believe was culmination of a lot of things. The global economy was booming. India also had started investing, and the GFCF was growing. So if we have to focus on only one particular metric, it would be the gross capital formation in the economy. And the second thing I would say is during this particular boom in 2003 to 7, the corporate PAT to GDP also expanded tremendously. Now, this was a 5-year period where our earnings compounded by almost 27-28%, and hence the markets also actually compounded by more than 35% over a 5-year horizon. So it was very much a fundamentals driven market rally, but of course it ended with the global financial crisis. And what happened post that is that in that global financial crisis, our economy actually did not suffer. It was our markets that did suffer by 60-65% because we had run up a lot, but it was never our economy that suffered. And then the prescription of the RBI and government of the day at that point of time was to provide more demand stimulus, and that led to an inflationary period for India from 2010 to 14. Coming back to the corporate PAT to GDP number, it expanded to almost 7% of the GDP at that point of time. India's economy used to be 1.5 trillion. So 7% of that, roughly about $75 billion, was the size of the profits of corporates in India in 2007 peak. Now, after that, the corporate profits kept declining steadily for the next 13-year period, and it bottomed in March 2020 during COVID at 1%. So, a lot of things that led to the decline. One was we as a economy and as a capital markets were very leveraged, and that deleveraging took a lot of time. We did not have in place kind of blocks or the mechanism in place to get the deadwood out of the economy and restart the economy. See, one thing that I admire a lot about US is, does not matter how deep a trouble that they get into, but they get out of it very quickly. They are able to whatever excesses that they were there in the previous cycle, they get rid of it very quickly, and hence the new cycle can restart quickly. But that was missing in India. That is why it was a very prolonged downturn. Almost a decade was kind of lost. So 2014 to 20 was a period where we started rebuilding the economy and putting in place the mechanism that is necessary to get rid of the deadwood, put in more supply side reforms, keep building capacities on the infrastructure side, put in place institutional capacity, infrastructure capacity, and there are still some bottlenecks still left to be declogged, whether it is the judiciary or opening up the markets in terms of signing up FTA. Those are some of the things that are still pending in terms of reforms, but we have largely now put in place a lot of things on at least the capacity front. So despite the fact that post COVID that a lot of developed economies are facing inflation issues, we are not in so much of a trouble. One, because we created supply, and two, because we did not provide a demand stimulus. So that has led to the inflation being manageable in India as compared to the developed world. That corporate PAT to GDP, which bottomed in 1% at March 2020, has started rising again. The initial rise, 1% to 4%, was because of the cost savings. During COVID, a lot of the costs were just not there, whether it was travel related and everything. And we figured out a new way of improving our productivity by, like we are doing one online webinar right now. The online webinar were not so common at that point of time. So we saved a lot of costs. There was belt tightening across. So the initial boost in the profit was because of that. But going forward, now the corporate PAT to GDP will increase more because, there is still headroom available in terms of growth. It's not like all engines are firing right now in terms of growth. Our capacity utilization is still hovering around 74-75%. So there is operating leverage also possible. There is room in terms of gross margin improvement as inflation slows down. Tax rates are this time are decisively lower than it was the case in the previous cycle, where it peaked at 7%. So tax rate at that point of time, corporate tax rates used to be 36-37%. Today, they are at about 25%. And for incremental new green capex that is happening, it will be at 15%. So a lot more profits will accumulate to the corporates as compared to the going into the government coffers. So this cycle of corporate profitability should ideally actually exceed the 2007 peak. So in this upcycle of corporate PAT to GDP, if we go now, coming back to the economy, if we go to $5 trillion economy, Whether it happens in 27 or 28 is the only question. But even with the growth rate, real growth rate of 6% and nominal growth rate of 10 to 12%, we will reach that number. It's not a no great shakes. It's only a question of mathematics. We will reach there. So now with a $5 trillion economy and corporate PAT to GDP, let's say going back to the 7% level, that will be $350 billion of profit. But in case it exceeds this time, which I feel it will, because the drivers are still left in terms of profits and profitability to grow in this corporate for this cycle, there is still levers available. So we will probably end with a $400-500 billion kind of a corporate PAT number before we peak out. Now, that means if I were to just give a 20 multiple to that, of course, corporate profit is listed as well as unlisted. But let's say for the moment that it is all listed. And if we give it a 20 multiple, which is what it's been getting since a while, that means we can become an $8 trillion market cap country. $8 trillion means entire market can double in 5-year horizon. So, of course, this is not going to be a one-way journey. There will be ups and downs. There will be ebbs and flows. Current period is one such where we might have taken one step ahead of the economy, and we might be factoring in a little bit of future. But the larger trend still remains, and it will remain intact because we are not an indebted economy. Neither the government nor the household nor the corporates are indebted to a level where we need to worry. So whatever problems world will throw at us, so for the origin of the problems for sure will be world, and it will result in either a growth slower down or it will result in margin impact. It will not be we will not be saddled with bad balance sheet for a long period of time. Now, heady mix of a high valuation, lower growth and lower margins is enough to cause a decent kind of a correction, and then the trigger could be anything. It could be a war somewhere in some part of the world, or it could be a an election result or something like that. Anything could trigger a correction. But my hypothesis is that because we are less indebted and it is not going to be a balance sheet problem, a 30% correction or 25 to 30% correction is the worst case possible. If and when that happens, I'm not suggesting we are on the brink of that kind of a correction, but I'm saying any pullback will unlikely to exceed that kind of a number. So my outlook for the next 5 year remains good. It will not be a one line straight up. There will be at least 2 10% correction and 1 30% correction in that 5-year horizon. But despite those two corrections, we find enough opportunities where we can compound our capital at 15% over the 5-year horizon. Sorry for that long drawn opening remarks. I hope I was able to communicate my view.
Absolutely fine. This was good, Ravi. So let us maybe now move on to doing a more quick conversation in terms of maybe shorter answers. So let me first understand from you, if you were to get money today from your clients, I'm sure you're getting in ValueQuest, a lot of people are sitting on liquidity and they're wanting to invest. How much time are you going to take to deploy that money?
See, it's a very dynamic thing. I cannot pre-decide how much time I'm going to wait. Markets are sometimes very swift and give a correction, and that might end up giving us an opportunity. However, the way it is right now, it's been some of the new clients that have come in the last 1 month are still sitting on 60-70% of cash. So that tells you that our deployment is slower than usual. And I'm anticipating it might take a month or two more. But these things change very dynamically, and I would like to retain that flexibility. If an opportunity presents itself tomorrow, I would like to deploy. So I am definitely not in the camp that believes that we have reached extreme levels and we are going to correct in such a significant manner that one should not be investing in the market.
Is your comfort and view on the IT sector, because that has not done at all well in last 2 years, because before that it really went up during COVID. So now here onwards, are you going to add more weights to IT, or you're still kind of, of the view that the things look hazy there and hence you're not that much in favor of adding too much in IT?
So first of all, we'll slice the sector. IT sector, when we talk about IT sector, it's a very generic term. There is a large cap IT, which does application development maintenance, primarily catering to the developed world. Then there are smaller companies in IT space, which are probably tier 2 vendors. Then there are ER&D companies, which are catering more to the manufacturing side rather than to the BFSI side, which most of the larger guys cater to. Then there is platform companies and there are product companies. So IT space is not a homogeneous space. There are 5 different subsegments. There could be more also coming along the way, but we don't have AI as of today, or we don't have any kind of cutting edge technology work happening, at least not in the listed space. So we are going to leave that out of the conversation. But having dissected the sector in these 5 buckets, it is primarily the narrative and the performance is driven by the large cap IT companies. Over there, I'm a little less bullish. See, you have to understand that in the cycle of this industry, it's a mature industry. I still remember 22 years back, these were companies that used to grow 100%. There was a 4-5 year period where these companies grew 100%. Those were the Y2K days. Now, the growth has become anemic. It is pretty much like 1-2%. And even the quarterly guidance that you see, they give 1-3%, and then they within that 1-3% they downgrade it to lower end of that 1-3% range. What does that tell you? Yeah, that's like, this is not a sector that is ever going to go back to 20-25% kind of growth. Now the only point at which you can make money in this kind of a sector is when you buy it when it is absolutely cheap. So if you do kind of a, what is the kind of growth built into the numbers, into the valuation, anytime you see that the built-in growth is less than 5-7%, would be the time to bet on it, because I believe it will be a 8-10% kind of a growth. 4-5% is the overall technology spending, and 3-4% is the market share gain that Indian companies will keep doing over the international competitors. So 8-10% is a growth, and the moment the valuations reflect a less than 5-7% kind of a growth is the time to bet on it. That is and then if you get a tailwind of the sector where the 8-10% growth goes to, let's say, 12% in a 2-3 year horizon, is where you will get 15% kind of a compounding on the earnings, and hopefully some re-rating on the stock also. So you will probably get 20% kind of a compounding on the stock in a 2-3 year horizon. So that's how I look at the large cap IT space, and that does not excite me. And right now the clouds are still very dark on the horizon in developed world, so that doesn't excite me.
Sure, Ravi. Sure. So, see, your views on IT look to be mixed. So, I was kind of expecting you to give maybe, either a bullish or a bearish view, but I understand.
No, I am on the bearish camp. It's not mixed. So there are some pockets where you can find some opportunities in the ER&D space, but the stocks over there are expensive. While the ones that are not expensive don't deserve to be any more expensive. So, but can I find one platform opportunity, or can I find one product opportunity? That is possible. So those are the areas to look at in the IT space, rather than look at the, the large cap IT space. That's what is not exciting enough for me.
What about large cap banking space?
That is an exciting space for me. I'll tell you why. Everybody knows, but I'll just reiterate and summarize the broad points. See, in the asset quality cycle, there is no doubt at all that this is the cleanest that the banking sector has been. The credit growth has barely begun. It's been like 6 quarters since the credit growth has begun. And this credit growth also till now has been pretty much retail driven. The capex cycle is just picking up. Till now, it's all been driven by central government capex. At some point of time, the state and the private players will also kick in. The private part of the capex cycle is what will drive most of the banking growth. Now, that I strongly believe remains ahead of us. Right now, still a lot of the capex that is being that is happening is either brownfield, or it is happening through the cash flows which are internal, rather than through bank funded capex that is happening. So the capex cycle or the credit growth cycle is ahead of us. NPA cycle is behind us. There is some amount of pressure on the NIMs that we were witnessing because of the rising interest rate scenario, especially on the NBFC side. So that, I think, now with the pause in the interest rate by RBI is also seems to be behind us. Now not only RBI, even Fed has paused, so the pressure on RBI will ease from here to increase interest rates further. So everything points to the fact. Now coming to, you can see the results and the way the results have panned out. The growths are fantastic, the profit number is fantastic. So in this kind of a scenario, what we are looking for is first a bank that has a great deposit franchise. Then we are looking for banks that have a great execution cycle in terms of their ability to collect, their ability to keep their NPS controlled. Because these problems that will occur in banks won't show up now. It will probably show up 3, 4, 5 years from now, because right now we are still in an upcycle. Third, we want to look for banks that kind of can control the costs, because finally we want to play on the operating leverage. So there is a big operating leverage play that is available. There is a big banks slash NBFCs, financial companies that can raise funds at higher multiple and yet lead to lower dilution for the existing minority shareholders is also another thing that we look for when picking and choosing. But the runway remains long, and I don't see any major worry on the horizon, except for a little bit of valuation stretch in some of the companies and some margin worries somewhere.
So, I'll give you the context that we want to cover in this webinar. You have given your views, opinions, and we have covered two major sectors in terms of understanding your thought process. And I agree with you on both these sectors and your views. But let us move to the second part of this webinar, which is like, why we kept this topic as high growth sectors and fast growing companies. Why we want to discover that, and why we have shortlisted or selected you as one of the fund managers. Because when I kind of see the numbers of your PMS that you manage, which is ValueQuest Platinum, you have been kind of giving returns of almost 29% in last 5 years as of today. If I say till 30th, October numbers, till 30th September numbers, right? So these numbers are like quite attractive, like 29% over last 5 years, year on year, as per TWR norms. And then when benchmark has given returns of like 15%, so it is like to have given almost 15% alpha. So obviously, it is from time to time that you and your team at ValueQuest have been discovering what are going to be high growth sectors and what are fast growing businesses. So in that regards, how are you going to structure your portfolio today in terms of, say, allocation towards mid, small, large, or allocation towards what sectors in terms of top weights? That is the context that we largely want to cover, in this webinar in very realistic manner. So that is where I was trying to understand, what are your views with regards to these two sectors. So let me now maybe ask you a question in a straight way. So today, what is the top holding in terms of sectors that you have in your portfolio, or maybe how do you see your portfolio actually evolving? Where do you see are the maximum opportunities in terms of generating alpha?
Sure. So Kamal, if you allow me, what I'll do is I'll briefly touch upon the framework or what lens we look at the market again. So that will provide a little bit of context into what sectors we are looking at from this point on, sector or theme. So we are stock pickers, but we are not only bottom up stock pickers. We try to first identify an opportunity top down in terms of which sectors and themes are likely to do well over a 3 to 5 year horizon. So it is very important for us that whatever stock we pick in, that the sectors and themes have a tailwind. We don't want to get stuck in value, the typical value labeled stocks or sectors where the value doesn't realize in our investment horizon. We don't have a 10, 20 year time horizon. We don't have a less than 1 year horizon. Ours is a rolling 3 to 5 years view. And the stock or the sector has to perform in that time frame. For that to happen, first we try and pick the stock, and then we try and pick the best positioned company within that sector so that we get that kind of earning. So our rule of thumb is that if it is a large cap, we ideally would want at least 18 to 20% kind of a earnings compounding story in a large cap. Or if it is a mid cap, then we would want at least a 25 to 30% kind of a compounding story in the mid cap. And if it is small cap, then we would want ideally a 30-35% plus kind of a earnings compounding. Now, but the biggest determinant of the earnings growth usually is the sector tailwind. If the sector is facing headwind, very unlikely that you will pick a company that is doing very well in that particular sector. I mean, it is very difficult to come up with one company that is doing well while the entire sector is not doing well. So we don't like to play those kind of stories. And in conjunction with what I explained to you about the economic cycle that we are in, usually in an up cycle, usually in a rising profitability cycle, what happens is the profit pie is growing and the number of companies that are participating in that profit pie is also growing. So for us, the universe is actually expanding right now in terms of the number of companies that are doing well. If you rewind 5 years back, you will remember a time period in 2018-19 where very few companies were doing well. Only some 10-15 companies were doing well. That Ritik. So what was that? That was more a phenomena of the profit pie was shrinking, and that shrinking profit pie was getting distributed amongst fewer and fewer companies. So now that if I am right about my judgment about the rising profit cycle, then there will be more and more companies that will be growing the profit at a 20-25% compounded level. Now that means it's a good time for somebody like us who are looking for that kind of a growth. So in that, some of the sectors themes that we have identified are energy transition, manufacturing, third is consumer discretionary, and fourth is financials. You asked about what is our top weightage. Our top weightage is financials, clearly. Within financials, we have lending as well as non-lending financials. In the lending financials, we have one private bank, we have one large NBFC, we have one a small NBFC focused on small businesses, we have one housing finance company, and we have a small bank also. On the non-lending side, we have a wealth management company and a general insurance company. So that kind of makes up our top weightage in terms of sector. But the other big theme that excites us is the kind of energy transition and manufacturing. And I am talking about both the opportunities in the same breath because energy transition is a global theme, and so is China Plus One, where essentially realignment of supply chain is happening, and that is leading to a lot of companies in India benefiting of that trend. So despite the fact that global economy is not doing well, some of the companies in these particular themes are actually still doing well because we are benefiting from the supply chain moving away from China towards India. So those are the four themes that we like, and I mentioned the sector weightage that we have.
Sure. So over the last couple of years, the way we have seen markets actually moving from the quality side to the non-quality side or a value side, like PSUs, infrastructure, real estate. Some of these segments were actually not at all favorable, and we had always learned that these businesses are not going to compound forever, and these are not scalable businesses in terms of generating ongoing long-term profits. So these three segments, or maybe any such fourth segment which is still value or was seen as value, like infrastructure, real estate, PSUs, and likewise, what are your views? You see them as a total change for long term, or it was just a kind of a trend that happened in 2 years and you are not kind of going to follow that for long?
So see, again, I'll go back to the lens that we use. We look at it through a opportunity point of view. We look at, is the pond growing? Then within that, is that fish also growing, and does that fish have the right to win over there? Let's say we take PSU banks as a sector just for representational and example purpose. There is a cycle that is on an upswing, and that is why every bank is doing well. It's not like there is any kind of a differentiation right now, which bank or which NBFC is doing well. All of them are doing well. Now, that is okay. There is some amount of valuation comfort that was built probably in the ignored PSU bank sector. So they got a little bit of benefit of the cycle, and they got the benefit of the re-rating also. But after re-rating also, they will always look cheap. So, but we are not very keen on this particular sector because, see, they don't have any right to win over here. They are essentially consortium lenders. Maybe there is an odd bank out over there which has the size and the reach which the private banks don't have. But over a 10-20 year horizon, you can be very clear, very sure that this is a stealth privatization that is happening. The private sector is going to take away more and more market share. There is absolutely no right to win that these PSU banks have. Plus, they have these issues regarding the MD of the bank changing every 3 years. And this is a people business, banks essentially. So if the leadership is changing every 3 years, that leads to some amount of cleanup from the the outgoing MD to the new MD coming in. So it does not fit into our secular framework. We ideally like businesses that have at least, even if they are cyclical, the cycle should be at least 5-7 years long. And if that is the case, then you will be able to capture a 3-4 year cycle. If you start with something that has a 2-3 year cycle only, then it is very difficult to enter and exit within 12 and 18 months and capture on any particular cycle. So we classify PSU banks as a reversion to mean trade and not a secular cycle. Coming to some of the other, so we do have, it's not like we don't buy any PSU stocks at all. For example, defense is something that we bought, and but that is more monopolistic nature of the business that attracts us. So along with the size of the opportunity, what you want is that it's not just top line growth, it should convert into bottom line growth as well. And that bottom line growth can be captured only if the competitive intensity is low. So that's why these so for example, if today you want to buy a light combat aircraft, there is only one company which is okay, I won't name the company, but there is only one company. If you want to make warships, there are only 2 or 3 companies, and really making the large size frigates, there is only one radar making company. So this is pretty much a monopolistic PSU space, and they have a long runway in terms of 5-10 years ahead of them. Sure, valuations have now recognized, the markets have now recognized the opportunity, so they are being aptly valued as against what they were not being aptly valued 4-5 years back. But the key enabler here was the import ban put by the government. Had they not put in that, then it would have remained open to competition from imports. And in that kind of a scenario, the right to win does not exist for these companies as well. So that protection was actually very much necessary and important for these stocks to do well. Debate about quality. So I am, pardon me, but I don't agree with the the classification or putting X company in a quality bucket and Y company in a not quality bucket. So these are all cycles. When the cycle is good, suddenly you will realize that this company is also quality and that company is also quality. So what we do is not pick the absolute AAA blue chip companies which everybody knows that these are fantastic companies and they should always be they'll always compound their earnings at XYZ% for a long period of time. That doesn't happen. There are in fact very few companies that compound their earnings or cash flows at more than 5, 7, 10 years kind of a period. So that is precisely why we focus only on this 5-7 year period where there is a fantastic earnings growth, and then market also re-rates it. The market tends to extrapolate that into the future and ends up giving it a very high multiple. But that is why we are focused on this. Rather than thinking through the quality lens, we think through the growth cycle lens.
Sure, Ravi. So, we have covered your thoughts on some of the high growth sectors and what differentiates your portfolio in terms of, how you view equity markets and how you kind of approach this entire investments piece in terms of creating a portfolio. Let me also understand from you in terms of what we have been seeing, over time. Over time, we have seen, a lot of actually retail investors have been investing into small cap mutual funds, and small cap mutual funds have grown tremendously in terms of their AUMs. And we have actually seen why I'm asking this question, because your returns are good, but if we compare your returns to some of the small cap mutual funds, they have done really well. They have done equally good or maybe far better than this. But again, there are two kind of sides to everything. Their AUMs are like 40,000 crores, 30,000 crores, and you obviously a PMS which is founder driven would have around say 500 crores to say 2,000 crores. So there are some of HNI investors or ultra HNI investors who are also invested in some of those small cap mutual funds. There, what is your view? Obviously, you also would want to kind of grow your assets, but in the current context, you being yourself an HNI, an ultra HNI, managing your family money also, do you yourself kind of invest in concentrated way into PMSs, your own PMS in terms of skin in the game, or you also get kind of attracted to some of these small cap mutual funds and allocate to those funds?
So first of all, I mean, something that I feel like I don't belong to this line of thinking, which is small cap, mid cap, large cap. It's a nice bucket that we put companies into because now we are mandatorily driven by the regulator that we should do this. So yes, market will do that, but as an individual investor, it actually doesn't make sense thinking of it like this. I don't think of it that I want to buy a small cap company. I want to buy a mid cap company. I look for opportunities. I look for companies that can compound wealth. The faster the rate, the better. If the size of the company is small, consequently, my deployment of capital will be small in that company. I will not. So in a 5,000 crore market cap company, I'll probably not take more than 100 crore bet. In a 50,000 crore market cap company, I'll probably take a 500 crore bet also. So that is more the position sizing at your end. But I cannot start with the mind frame that I will invest in a small cap, mid cap. That is a wrong way to think about it. But unfortunately now a regulator has decided that 1 to 100 companies in this country are large cap, 100 to 250 are mid cap, and 250 to 500 are small cap. Another point I want to make is these mid and small cap companies are not small companies anymore. Today the 500 company in the country is almost 8,000 crore market cap. That's like $1 billion market cap. Now, if your size of the assets are small, how does it matter? I mean, you're still a small cap. The smallest of small cap is still $1 billion market cap company. So that is why some of these funds have grown to 30,000-40,000 crore and yet remain a small mid cap oriented sector fund, right? So I am very much against slicing and dicing the markets in terms of size of the company. Look at it always from the point of view of which sectors, themes, then identify which are the leaders, challenges, or disruptors. And it could be so small. The size of the company is determined by the pond that they are operating in. So, for example, the largest tile company would be way smaller than, let's say, the largest IT company, but they are each leaders in their own sense. And as I explained earlier, in a rising profit cycle, the profit pie is expanding and the number of players contributing to that is also expanding. So, barring a 6-12 month tactical, kind of a pause or a correction in the mid and small cap because they have run up a lot, I still remain very bullish that these smaller companies will actually compound their profits at a much higher rate from the next 4-5 years perspective. I hope that helps.
No, absolutely. This is a very insightful answer that I've given. Absolutely. So the second part to my question was, what is your personal skin in the game, your family skin in the game? Because it is like Dharamshi family, which ultimately evolved to kind of creating ValueQuest, and today you are managing a lot of clients' portfolios. So I want to understand, in ValueQuest Investment Advisors, what is the skin in the game that you have?
So Kamal, thanks for that question. See, we have always believed in I will never sell anything in which I am not a buyer myself. So I definitely want to be invested in anything that is sold, whether it is. So we have a private equity fund also that we have started 6 months back, and we have a PMS strategy also. And in both of those, the skin in the game is very high. the strategy that I run, almost 20% of the capital is mine in the listed side. On the private equity fund also, the idea is that at least 20%. Our target is about 1,000 crores raise on the private equity side. Again, 20% of the capital should be mine or my family's in that case. So that is the kind of skin in the game that we bring to the table. And honestly, it's not that I want to demonstrate skin in the game. I myself believe that there is an opportunity, and that is why I am investing in that product. So unless I strongly believe in that opportunity myself, I am not going to be raising funds from public in those products.
Sure. So this, takes me to the subsequent question. Let's now see, Ravi, you as an investor, because you have a substantial skin in the game, not as a fund manager. And every investor has some story in mind in terms of, how I am trying to kind of see what is going to happen over, say, next 1 year, 2 year, 3 year. Obviously, one understands, every investor, who is knowledgeable, experienced, has this, I would say, perspective that anything can happen. Equity is a long-term asset class. Risks are always there. Uncertainty is always there. But still, at the same time, there is some line of thinking, some optimism at some point of time, or some pessimism at some point of time, right? So in current context, what is your story, which is in your mind, in terms of what is going to happen in 3 months, in 6 months, in 1 year, in 2 years, when we are saying from 3.5 trillion, we'll be 5 trillion. Obviously, it will have, say, 8 quarters as a journey in it, or maybe 12 quarters as a journey in it. So I want to understand, how does Ravi Dharamshi as an investor view this over, say, next 3 years?
No, so see, clearly the valuations are more on the optimistic side right now. We are factoring a little bit of future, can't deny that. And there are some dark clouds on the horizon in terms of global economy and markets. So those are the things that do worry us. But what keeps me positive or optimistic from a longer term perspective is still that we are still very early in this cycle. It's been only 3 years that we are in this cycle, even less than 3 years, 2.5 years. March 2020 is when we bottomed, and we are in September of 23. We are in November of 23. So I still believe we are very much early stage of the cycle. It's not like all growth is firing in all cylinders or margins are at its peak. See, it's the reverse case in case of US. There the margins are at its peak. 13-14% kind of margin is the highest that US has seen. And also on top of that, they have had crazy kind of a interest cost increase, all which is going to get reflect in P&L going forward. So for all practical purpose, the profits might have peaked in US, and also interest rates have a kind of a gravity effect on the effect on the equity market. So if the interest rates have gone up, the valuations will actually come down. So now in this kind of a scenario where profits have peaked and the multiple might shrink, it is difficult, and it is a very I would definitely not be a US equity investor. Can you be a US bond market investor? I think yes, there is. Even the bond yield today is offering better yield than the earnings yield in the S&P 500 today. So that is a better space. And believe me, US market has recognized that. On surface, we feel that Dow and Nasdaq are not correcting. It's actually holding up only because of 5-7 stocks, or maybe 15 stocks. Exactly the scenario that we were witnessing in 17-18. And then, but if you look below the surface, the mid cap, small cap, over there, the Russell 2000 is really suffering a lot. And that is the general representation of the economy over there. While what is happening over here is reverse in India. It's the top end, the larger companies which seem to be not doing very well, which is why the index seem to be pedestrian returns. I mean, we were at 19,000 in October 21, and we are still at 19,200, 300 in Nifty, almost 2.5 years down the line. But underlying market cap has grown. Overall market cap of India has grown. So that is because more number of companies are doing well. And I would again like to reiterate that this performance is backed by earnings. Yes, we might have run ahead of the curve in terms of factoring in more of the future earnings, but it is not like it has happened. It has come on the back of only liquidity and no earnings or anything. It's just market has anticipated a little bit of future right now.
So what is your view on interest rates going forward from here onwards?
In India, they have most likely peaked. In US also, I feel the monetary policy has peaked for the moment. But again, never ask a micro stock picker their macro view. So I have no authority on this subject. It's more a general feeling that I get that the repercussions of the kind of interest rates increase that has happened in US will be visible over the next 4 quarters, and that will not be pretty picture. And usually this is a tool which acts with a lag impact. So the interest rate increase in the last 12 months is going to have its impact on the economy in the next 12 months. So that is how I think about it. And usually Fed is behind the curve. So the economic data going forward should start coming back. Initially, that might be a good thing for the markets because market will interpret that as interest rates are not going up. But eventually, when Fed realizes that they might have done more harm to the economy by the kind of interest rate increase that they've done, and they will start cutting, is when we should be really worried, because that means would be an admission on part of the Fed that they are behind the curve.
Sure. No, absolutely. I know you're a micro focused fund manager, but when we see you as investor, then obviously you, I'm sure, would have some perspective on macro risks or macro.
From India's perspective, I don't think interest rates are rising too much from here. I think inflation is very much under control, and it is not that big. In fact, our cycle seems to be slightly disassociated with US Fed cycle.
Right. No, I agree with you. Absolutely. So it's like, it looks like that, yes, interest rate cycle has kind of more or less peaked. From here onwards, I know, one cannot predict what will happen to the geopolitical situation and then crude prices, and then obviously interest rate and inflation are all correlated, but still, putting economics in forefront and not geopolitics, one understands that, yes, it seems to be picking. But still, I would want to ask you one more macro question, which is all the more macro, which is like, what is your view on, or maybe, are you factoring in any risks with regards to elections next year as an investor? Because you talked about 25% skin in the game, and I know the AUM of the portfolio. So obviously, it's you are one of the largest investors in your own PMS. So from that point of view, I want this question to be asked from the point of view of a lot of such investors who are owning 75% of your PMS and who would be thinking and who would be wanting to maybe add more or take out some money before elections. So what is your perspective in that context?
So Kamal, the probability of the theoretical risk is very low. I think for all practical purpose, the current dispensation is likely to be back. Whether they come with fewer seats or more seats is the only question. And the continuity and the political stability that India has witnessed should ideally continue. So that remains our base case, that current government comes in probably with same or higher margin, no problem. If it comes in with fewer seats but still majority, again, no problem. The third scenario, where it's a coalition or the opposition comes into power, is something that will definitely worry investors initially, and we might witness a steep correction. However, again, see, we have to build a portfolio beyond any particular government. You cannot mix your politics and investment. You have to be focused on, is the business cycle going to continue or no? The new government will probably reprioritize some of the things that this government is doing. So yes, your kind of the portfolio or the nature of the portfolio will change. You probably would be better off investing more in consumer oriented stories rather than capex oriented stories, because a lot of the capex oriented sectors are driven by the intent of the central government at this point of time. So that risk remains. So incrementally, we are not deploying too much more capital in some of the sectors like defense, railways, capex oriented sectors, capital goods, where there is a higher risk right now, because it's not a higher risk, but the risk is higher for these sectors as compared to some of the other sectors in case the government was to change. So that is not my base case. So I am invested, I continue to stay invested, but we have reduced our exposure to these sectors right now.
Ravi, I think, I have understood quite confidently how Ravi as a fund manager thinks, how Ravi as an investor thinks. Now we move on to the last section, where I want to understand, ValueQuest as a institution that you are kind of leading. The name suggests that you are value conscious, value focused investors, but you had mentioned that you are not just value pickers. So if in few lines, say in 1 to 2 minutes, you have to explain, to any investor, any client of yours, what do you propose as a offering, in terms of, say, first PMSs that you have, 2 PMSs like Platinum and Growth, to any investor?
So again, see, value and growth are actually joined at hip. It is not that we don't want to invest in company that is value but has no growth. Neither do we want to invest in growth companies that has no value. So it is a combination of growth and value. You have to buy growth at a reasonable price with a minimum quality of the company. Sorry, when I say minimum, I'm not talking about the least, but I'm talking about there is a filter below which we will not go. But sometimes what happens is when the sector picks up something that has been in our conscious mind categorized as not great quality, but that was more because of the cycle of the sector rather than because of the acts of the company. Those companies we are okay to invest in. So if you were to attach one particular name to what our style of investing is, scale investing. We like to identify companies that change scale, that go from being mid cap to a small cap to a mid cap to a large cap to an ultra large cap. Essentially, we are looking for companies that will grow way faster than the economy, and we would like to pick good enough stake in such companies and ride the growth phase.
So what is the difference between growth portfolio and platinum portfolio?
So growth is managed by Samir, my co-founder. Platinum I manage myself. The essential difference between the two is the style difference between the two fund manager. Outlook difference, entry point, exit point, holding period will differ. So Platinum has a 1 to 3 year outlook, growth has a 3 to 5 year outlook. But what remains common amongst both the two are, it's a multi-cap strategy, it's a sector agnostic strategy, but probably I can say Platinum is slightly more actively managed.
Sure. Besides these two, you have also recently launched, you covered that in unlisted space, a late stage, private equity fund. So do you really see that there is a possibility of one making higher returns in that particular category than even in the listed space? Because the costs in that category relatively would be higher, taxes would be higher, there are higher risks, illiquidity is higher. So from the point of view of investors, if your portfolio like Platinum is generating 29% return over the last 5 years, one kind of makes that, understanding that in the next 5 years, when we are all the more bullish on India as an economy, one can at least think of making 25%. I'm not saying any assurance. I understand that equity doesn't give any guarantee. But if one has to compare in terms of risk reward, why would one invest into unlisted fund when risks are higher and the commensurate expected return is not higher? So I want to understand from you, what is your logic of kind of delving into that category? I'm sure there are higher potential returns, and how much higher potential returns are expected, and why and how is what my question is.
So the hope is always there. As you mentioned, one cannot guarantee or promise anything over here. But the fact that I am deploying a large part of my capital into this product as well would probably suggest to you that I anticipate the growth or the returns to be higher over here. But see, we are differentiated from the typical private equity product in the sense that we are not investing in moonshots all the time. We are looking for companies. So there is a funding winter going on in the private equity space where business models which are burning cash are not getting money. But what is happening is, along with the business models that are burning cash, the regular business models, the brick and mortar business model, which are doing quite well and only need growth capital, not survival capital, are also not getting money. The IPO cycle, so usually what happens is, first the secondary market does well. After secondary market doing well for a 2.5 year period, the primary market picks up. We are in that phase where the primary market has picked up. And then after the primary market picks up comes the private equity. So because once people start seeing exits is when the private equity comes to the market. I mean, they come to raising capital and all that. So this is how usually a cycle progresses. And we believe we have entered the market at a stage where we are ahead of the curve in identifying companies that will go public 2-3 years from now. Or we have already made a portfolio of 7 companies. It's a good mix of growth capital oriented companies and pre-IPO companies. So that will then it's a 5-year 5+1+1 product, so much shorter duration than most products out there. So our idea is to start returning capital also sooner, probably in 3-4 years time, because the pre-IPO companies, that couple of our companies are already listed, and they start giving you the liquidity to the portfolio, which usually the risk associated with a private equity product is that it is illiquid product and there is a lock-in. So we have tried to address that by having a good mix of pre-IPO and growth capital. So growth capital companies are one that will provide me the higher returns, and it's the pre-IPO kind of companies that will provide us the liquidity, and we will be able to balance that and hopefully return MOC of more than 2.5x, which is basically 2.5x return in 5-year horizon, which does not sound too much different than what returns we have made in the recent past, but trust me, that should be the expectations. If we make more than that, that's well and good.
Yeah, I understand. Absolutely. This is like, every investor looks for, differentiated portfolio, and every asset class has its own risk reward, I would say, risk reward spectrum. And from that point of view, when we kind of want to create an HNI client's portfolio, listed as well as unlisted space have their own spaces. And you kind of answered that well. We move to the last question, which I ask mostly, very rarely, such fund managers who have really done well. And it is important to understand, this answer, because with success, one tends to forget that one can make mistake also. So I want to understand, do you see that, yes, I have, as a very successful fund manager, had few learnings. There were some mistakes which could have been avoided, maybe during COVID times or after that. And if you can give some evidence, that will kind of give a final perspective.
No, so mistakes are absolutely part and parcel of the investing process. And if somebody says they have made no mistakes, then I think, they are genius and rarity. That doesn't happen. So, but what we should do is keep the mistakes affordable. And second thing is that we should learn from our mistakes and incorporate that learnings from that mistake into our philosophy or strategy. So once that is done, that is how you grow. Our game, investing is essentially a game of survival. If you survive a bad cycle, you will emerge stronger in the next cycle. So some of the examples of the mistakes that we have done in the last, let's say 4-5 years back, which kind of helped us grow and we learned from that, is we used to bet on turnarounds. That was also a reflection of the stage of the economy. There were many turnaround bets available at that point of time. Today, we don't have too many turnarounds. Most of the turnaround have either fallen by the waysides or they have turned around. So turnaround was something that we bet a lot on 5 years back. Today, we don't have too many, not more than one turnaround, and that also will not be a balance sheet turnaround. It will be, company should be able to turn around based on its own cash flows, and not a balance sheet turnaround, but a P&L turnaround. So that is one thing that we learned. I will not name companies right now, but that's a lesson that we learned. Second, we bet on companies which were driven too much by regulation. Government regulation was forcing opportunity towards a particular company. But if it has to be accompanied by economics as well. If it is driven purely by regulation and not by economics, more likely that the customer will not go ahead with whatever that is being mandated. So it is very important that there is economics associated along with the regulation, and it should not be single engine that you are betting on. There has to be multiple engines that have to be firing. So in case one particular engine doesn't fire, then the others can take over. So the kind of odds that we would like to play is that if we are wrong, we should ideally compound our capital at 15% on a 5-year horizon, and if we are right, we should compound at 25% on a 25% plus in our investment horizon. So that was one more lesson. Third, we put in a filter that we will not bet on companies below 100 crore PAT. What that did is it took care of not betting on loss-making companies, not betting on very small companies, and also not betting on probably number 6, 7 kind of a player in the industry. We want to bet only on leaders, challengers, or disruptors. So that is one more learning that we had. And we have learned from some of our mistakes, and that's how these learnings have culminated into the strategy or the portfolio construction that we do now.
Sure, Ravi. I think we have covered everything, and you kind of covered and answered all the questions, like really awesomely. And this brings us to the end of this webinar, and I really thank you for sparing your time today on the Friday evening. We understand, yes, ValueQuest has been doing something differentiated, and it was important to do this webinar to kind of present it to our audience and to our clients that what ValueQuest has been doing. I think we know we need more of these webinars and more of these discussions as markets evolve. From here onwards, I kind of conclude by saying that you have an optimistic view, high skill in the game, deep experience, and kind of you are taking it very, very, I would say, seriously. It's like you're investing clients' money with a lot of passion, and absolutely that is what kind of drives the returns. And good luck to you for future returns. It's as you mentioned, a business which requires ever learning, and if you stop learning, obviously you will stop being in the game. So one has to survive as well as thrive. Absolutely, you bang on whatever you said in that regards. Thank you so much, everyone.
Thank you so much.
Pleasure.